Institutional asset consultants need to ensure that pension funds adhere to Regulation 28, the Pension Fund Act. They also need to ensure that assets are correctly invested and then apply general prudence when advising boards of trustees when it comes to the investment of pension assets. This is an all-important role and one that should not be taken lightly. On that note, gentlemen, I welcome you. And Rob, I think I've given a good indication in terms of what you actually do on a day-to-day basis, but give us an indication of the role you play within the industry.
Lenny, I think the major focus for us is ensuring that boards of trustees who are not professionals, they are typically employees of corporates. They may not be investment and pension experts, and it's really to help them manage their funds appropriately, help them understand investments, help them with the decision-making processes, and really take them through the whole investment process, ensure that they understand governance, what the law requires of them, so that ultimately they can achieve the objectives for their members. And
absolutely, a lot of changes happening with Regulation 28, so I'm sure quite a tough task for you, Rob, that has come to the forward.
Yeah, I mean, I think the other important thing is the fact that a lot of this is legislated. So, Regulation 28 allows and asks of boards of trustees that if they don't have the skill level in order to actually deal with some of the investment issues, that they actually get an investment consultant involved in the board of trustees so that they can make prudent decisions. And as a matter of fact, if you look at your screen right now, you'll see the life cycle that institutional consultants would be taking boards of trustees through, and this investment life cycle basically deals specifically with just the various facets. It starts off with what we call fund member analysis. That's yearly planning, ensuring that the liabilities, that you understand what the liabilities are, and ensuring that you're matching the assets to those. You then move to governance, which is Regulation 28, and we're going to talk more about that a little bit later on. Setting investment objectives, those are for individual members, but it would also potentially take into consideration maybe setting investment objectives for the overall fund. Strategy and asset allocation, how much money do you want to put into equities, how much you want to put into bonds and cash and various other asset classes. Portfolio construction then, who you're going to choose to manage it, and then actually the monitoring at the end of the day. I mean, Rob, maybe just a question from my side. How important is this life cycle? I mean, we see this in the industry, and I mean, this is what boards of trustees look at on a daily basis. How important is this for you guys?
Kirby, this is critical. I mean, everything we do in terms of our advice to clients is based on the cycle. Clients are at different areas of the cycle, sometimes within a year, but every single year you want to be going through that cycle. Doesn't necessarily mean that you make changes, but it does mean that you stop, you understand, you know where you are, you understand the reasons why you made those decisions, and then you move your way through the process.
Yeah, and I suppose the devil's in detail here as well, and that is that you have to ensure that it's easy just to follow the steps, but applying general prudence rules as far as investing is concerned is obviously critically important.
So, I mean, Roland, do asset managers get annoyed with dealing with consultants?
Why are you asking me that question?
No particular reason, really.
Sell side.
I guess asset managers increasingly are seeing asset consultants and multi-managers, which is a part of asset consulting now in many cases, as a client, whereas before, many years ago, you used to have the asset managers deal much more directly with the pension funds themselves. So I think the multi-manager has played a much more important role in the recent past, and I think they're probably more frustrated with the kind of impositions in terms of portfolio construction that multi-managers are demanding, but not necessarily the asset consultants, which are much closer to the pension funds themselves. Is that probably a fair reflection?
Roland, I think that's about right. I mean, certainly over time, there's been a much closer working relationship between asset managers and investment consultants. So historically, investment consultants would recommend products that asset managers made. Now, there's a lot closer engagement around going to asset managers who have a specific skill in the area and saying, can't you do a little bit of this? The liabilities of our client need something around this area. Can you help us build this proposition? So it's not just going out and buying a product off the shelf. There is still a lot of that.
I guess the important thing for you guys is, or for the pension fund and you providing the pension fund with us, is sort of risk management and liability matching or hedging or whatever you want to call it. And the asset managers can't do that because they are only seeing a portion of the overall fund. So at fund level, there's a lot of important decisions that have to be made, and that's very much increasingly becoming your role than in the
absolutely.
long past.
If you go back to Kirby's circle, half of that circle doesn't involve anything to do with an asset manager. The critical thing is if you go to a typical trustee and you say, what does an investment consultant do? The first thing they're going to tell you is they're going to help them pick managers. But that's only half the job. If you haven't done your job, the first half of the circle correct, doesn't matter how good your managers are, you're not going to achieve your objective.
We've seen a few changes when it comes to Regulation 28 with regards to the limits. I mean, equities up to 75%, 10% within the unlisted space. I know Kobe's got a graph for us on that. What do you make of all the limits that have actually been put in place? We know we've seen quite a few adjustments. We also know that within the deregulated space, you also have more leeway than what you had before. What is your view?
I mean, I think I want to take a little bit of a step back in terms of regulation, and it says where have we come from with regulation. Now, the old Regulation 28 was a set of rules. The new Regulation 28 sets out rules, but also a whole lot of principles. So, and one of the shortcomings of the old Regulation 28 is that you could be compliant with the law, but you could be sinking your retirement fund because your assets and liabilities were not appropriate. So certainly the principles around that have made a sort of a major change in the environment. As far as some of the limits are, you know, increased allocation to things like hedge funds, private equity, unlisteds, certainly talks to a whole lot of things like infrastructure. We know that in this country we need a lot more focus on infrastructure development, and this enables trustees of boards to investigate these types of opportunities, generate returns for the membership, and at the same time making a substantial improvement and contribution towards the country.
So could we take us through some of the limits?
Yeah, I mean, let's have a look at the principles that kind of underpin Regulation 28. Again, what Rob said just now, remember that the previous Regulation 28 was kind of limit focused. Much of those limits already still exist, but kind of the principles are more important. Have a look at your screen at the moment and you'll see in order to be prudent, those are some of the principles that your Board of Trustees should be thinking about. You can see general education of the board. That's something that should happen on a yearly basis, both from an investment perspective and just generally from an administration perspective. Monitoring compliance, broad-based black economic empowerment. Very, very important, making sure that the assets are appropriate for the liabilities, and that's a yearly exercise that you need to be doing. Perform reasonable due diligences. Foreign assets, perform reasonable due diligence again before investing in foreign assets. Credit ratings, and so forth and so forth. I mean, many of those things become critically important when one is looking at potentially acting on behalf of somebody else's money. And that's in essence what trustees are doing. Yeah. They're taking a company's pension fund and they're busy saying, how do we best apply ourselves to this situation? We understand there's some limits, but what are some of the broad kind of principles that are kind of that are at play? I mean, Rob, one of the things that are kind of around those broad principles at the moment, and one of the things that are being hotly debated in the industry at the moment, is this whole thing around daily compliance. I mean, usually it was around quarterly compliance. It's making sure that on a quarterly basis, that the assets that you hold from a pension fund perspective, that you report that to the regulator. Now it becomes daily. I mean, what are some of the technicalities around that?
Kobe, it is an area of I'm hesitant to use the word confusion because the law is quite clear. The law says you need to be compliant at all times. Now, at all times means that you effectively need to be monitoring and recording your assets, wherever they may be, in South Africa or foreign, etc., on at least a daily basis. The problem that you have with that is that a lot of the reporting systems can't do that, which means that you often have to go and look at things like an investment platform. An investment platform are typically what the multi-managers have. They do daily unit pricing and they actually do compliance on a daily basis. But those things all come at a cost. And so a lot of retirement funds have gone back to the regulator and they've applied for exemption, which is a thing that the FSB's kind of encouraged. They've said, if you believe that the regulations is inhibiting your ability to achieve your objectives, apply for exemption. So a lot of funds have gone back to the FSB and they've said, if you really want us to do this, we can do it. But it's going to cost us X many million rand a year.
Exactly, how much is it going to actually cost? And then would they then pass it on?
Yeah, look,
to their investors.
You know, depending on the size of the assets, your platform provider is going to charge you, probably between 5 and 15 basis points. Larger funds, maybe 2.5. So there is a cost, and that has to be carried over by the member. There's no one else to.
Has exemption been granted as yet?
We haven't had any exemptions being granted. To the best of my knowledge, certainly none of the funds that I've been involved with. And it's really a case of the FSB saying, we've seen your letter, we recognize the issue, and we're going to get back to you.
Okay, yeah.
Sorry, how do you deal with unlisteds in terms of daily reporting or things that don't have a price or that you can't mark to market? I mean, how do you do that?
That's one of the questions.
So it's actually physically impossible. I mean, what is an unlisted? Give us an example.
You could hold unlisted property. So you can hold a building in the centre of town. You know, we've had funds in the past who've owned a portion of airports. Not the major ones.
The price of that doesn't change day to day, does it?
No, there's no one doing a valuation of that.
But to give us an indication of the history behind the daily compliance rule and strategy, I mean, clearly they're trying to avert risk within a portfolio.
Correct. And I mean, I think the FSB needs to be applauded for the things that they're doing in this respect. Because what you don't want is, let's go back to a trustee board and remember who they are. They're not professionals, they've got day jobs, they're making widgets or whatever the case is. They probably meet quarterly. They might not know exactly what's happening in the portfolio. Even notwithstanding that they meet quarterly, they might not interrogate an investment in detail for potentially years on end. So there is potential for some of these things to go over limit. You forget where you invested. You're not being careful in terms of how you valuing your investments, especially things like unlisteds. And I think the regulator is just saying, let's bring this thing back together. Let's make sure we always understand where the assets are.
Okay, so I mean, when it comes to monitoring, I mean, we know that on a quarterly basis, things are being monitored. Now we want to take it to a daily basis. Do you think that it's necessary? Are you averse to it, Kobe? Or do you think that if it was done correctly, then we would actually avert?
Well, let's look at the big structures, the kind of structures that are available in the industry at the moment. You've got Regulation 28. Those are limits. Those are overall investment limits that you have to apply as a board of trustees. I'm yet to see a board of trustees that kind of just say, oh, well, look, there's a regulation, but I'm not going to worry about it. Most people take it very, very seriously. Secondly, most of your asset managers are mandated. That means there's a specific mandate that they're acting on behalf, and there's very specific benchmarks within those mandates. They might be absolute, but they might also be relative. Within that, you've then got investment policy documents and statements and a whole range of other things. So the chances that people are going to kind of go over these limits, or potentially kind of say, look, you know, I'd only have to report at the end of the quarter, you know, in the midst of the quarter, I'm going to do whatever I want to do. You know, that becomes quite difficult, especially in the regulated environment that we find ourselves. Most of the investments that we see in the pension fund space are all unitized, listed instruments. I mean, most of those unlisted are kind of legacy issues again, and I think Rob would agree with that.
It's a governance issue. In other words, the regulator wants to make sure that these investments not necessarily are priced every day, but that you know where they are, as you say, and that there is some kind of check on what these assets are actually doing. Because if you invested in some shady property deal, you might only know 6 months later that this thing is not...
Okay, but let's look at the limit for that. The limit for that is 10% on unlisteds. Yeah. So can 10% blow up a complete pension fund?
No.
Probably not.
Even so, the governance issue is, are we invested in businesses that are actually real and not, somehow...
I mean, when it comes to unregulated products as a whole, I mean, the maximum is around 15%, isn't that right? And that includes private equity and hedge funds as well.
Unregulated is...
Products.
That's quite broad.
You know what we should do is maybe look at your screen quickly. Let's just bring you into the debate here. Have a look at your screen. You look at the regulatory limits that apply to Regulation 28 at the moment, and you can see it says maximum for issuer sizes updated, and those are all just brand new kind of Regulation 28 numbers as you're seeing over there. 10% for unlisted shares, 75% for normal equities. You can see cash and money market instruments over there. Bonds, you can put 100% of your fund into bonds, but then there's some limits that apply, you know, for various subsections of the bond industry. Let me show you some more of those. Property, 25%. We spoke about unlisted property just now, 15%. That's the maximum you can have in those. And then look at all the other ones. Those are private equity, hedge funds, and commodities. There's gold, 10%. And then our other category, which always we kind of laugh about because we're not quite sure what falls in there. SARB allowance offshore, 25%. That always used to be much less than what it is now. So 25% is a sizable chunk that you can take globally.
All right, so Rob, give us an indication now in terms of what your thoughts are on some of those limits. And I'd like to specifically talk on, I mean, when I talk unregulated, I'm talking pension, I'm talking private equity, and I'm talking hedge funds in particular.
Really, I'm neither positive nor negative on some of these things. It really does depend on what the fund's objective is. What we do know is that the new regulation provides us with a lot more tools to enable us to achieve the long-term objective. So things like private equity. Private equity is a fantastic investment. There are admin complexities around in terms of defined contribution funds, who picks up the fees, because in private equity, the first time you go in, you're paying your fees, but there's no return, which can be for a period of up to 5 years. So what if you're invested for those 5 years, then you resign from your company, you effectively carry the whole cost, but you don't get any of the benefit. So there are issues around that, but the instrument per se is really interesting and does form and should form a major part of long-term strategies.
Okay, fantastic. Roland, would you like to?
Yeah, I think just quickly on the offshore side, I guess a global company has a much bigger appeal to a board of trustees, because it's pretty tough if you're a South African asset consultant only, and 25% now is going offshore to go and do all those due diligences, and I guess offshore it's also equity, bonds, private equity, hedge funds, all of that sort of thing. So I mean, you guys have got a lot of experience internationally with this kind of thing, but is that something you're increasingly seeing with trustees?
Definitely. You know, at the old limits of 15%, it wasn't a major factor. 25, a quarter of your money could potentially be offshore. You really need to understand the offshore managers. Surprisingly, maybe it's not so surprisingly, if you look at the offshore propositions of some local managers, so whether you take, and I'm just going to pick a few, not necessarily based on performance or whatever, they've got credible capabilities. You've got an Investec, you've got your Coronations, guys like Oasis pick offshore shares from South Africa. You can, and you can credibly do it. The other alternative is that you go and you buy a Walter Scott, or you go and buy a Marathon. But then you've got to have you know, probably the biggest issue for us is, does Marathon understand the South African liability, and does it work to just bolt them on to a South African fund? We are getting to the point where we're saying we're not so sure that.
Did you manage currency risk? Hedge it? Or?
Very few managers that we've engaged with. It's not because we have a particular view on it. Very few asset managers have come to us saying that they can do it, because it is so hard.